You know something? Most think risk management starts after they enter the trade, after the setup, after the analysis, after conviction. But usually, the damage already started before the trade was even placed, because the real mistake wasn't the entry, it was the size. You can actually survive a bad trade idea. What destroys most traders is oversized exposure attached to a normal mistake. And the dangerous part is, it rarely feels dangerous in the moment. It feels confident, it feels aggressive, it feels like belief. You see one setup that looks perfect, and suddenly the position becomes bigger than your process can emotionally handle. Then one candle moves against you, and now your decision making changes completely. You stop following the plan, you widen the stop loss, you watch every tick, you pray instead of execute. That spiral usually starts from one thing: position size that was emotionally chosen, not structurally calculated. A structured trader doesn't begin with, "How much can I make from this trade?" They begin with a much quieter question: how much am I willing to lose if I'm wrong? That changes everything. Because trading is not built on certainty, it's built on controlled uncertainty. And position sizing is what converts that idea into actual survival. Let's simplify this. Imagine your total trading capital is 8 lakh rupees. Now, before the market even opens, you already decide one thing: you will only risk 1% of your capital on a single trade. Not because 1% is magical, but because consistency needs boundaries. So your maximum acceptable loss becomes 8,000 rupees. That number is important because now the market no longer decides your risk. You decide it first. Capital 8 lakh rupees. Risk per trade 1%. Maximum risk 8,000 rupees. Now suppose you find a setup. Stock entry is 1200 rupees. Your stop loss is 1160 rupees. That means your risk is 40 rupees. Not complicated, just entry minus stop loss. And now comes the part most beginners skip. Instead of buying random quantity or using gut feeling, you calculate position size based on predefined risk. So if your maximum risk is 8,000 rupees and each share carries 40 rupees of risk, your position size becomes 200 shares. Now look carefully at what just happened. The trade was not sized based on excitement, not based on available margin, not based on "this setup can't fail." It was sized based on acceptable damage. That's professional thinking. Because the market can still hit your stop loss. You can still be wrong. But now the mistake is controlled. And controlled mistakes don't destroy trading careers. Uncontrolled exposure does. Most traders spend years searching for better entries. Very few spend time learning how to survive bad ones. But survival is what keeps you in the game long enough to compound. That's why disciplined traders become strangely calm over time. Not because they predict better, because before the trade even begins, they already know the maximum damage possible. That removes emotional chaos from execution. And once position sizing becomes automatic, fear slowly reduces too. Because now, every trade has boundaries. This week, try observing something simple. Before entering any trade, don't ask, "how much profit can this make?" Instead, ask, "if this trade fails completely, does my position size still respect my process?" That one question alone can quietly change the future of your trading account.